In this session, let's look at the company analysis, wherein our intention is to come up with a process which helps us in doing the forecasting of the financial statements. That's the major thing that we do as a part of this session. If at all I have to make a forecasted financial statement based on the historical financial statements of the company, what is the process that I typically follow? Right? So, because as a part of equity evaluation, we will be using various methodologies, let's say like discounted cash flow methodology, wherein we are trying to find the future cash flows and then try to discount them to the present value. And if at all I need the future cash flows, obviously I need the future financial statements, the income statement as well as the balance sheet. So what we are trying to understand from this session is how do I typically go about forecasting each and every element of the financial statements in order to do an in-depth valuation of the company. So this helps me in trying to come out with identifying the various elements of the financial statements and on what basis generally I do go about with their predictions and forecasts, so that much better valuation can come out from those financial statements. So when we look at the typical development of the inputs, generally we follow either a bottom-up analysis wherein we look at the company, you look at directly the financial statements of the company based on the industry in which it is operating and the country in which it is operating. So whenever I am doing the forecasts, let's say for the revenue, we purely look at the company level data. Okay, at what rate the company has grown its revenues in the last few years. Okay, 1 year it has grown at 10%, the other year at 20%, the other year at minus 5%. Historically, these are the kind of growth rates this company has experienced in its revenues. So what you can very well do is, based on the historical growth rates of the revenues, you arrive at one number which you will use for prediction, for forecasting the revenues for the future period. So the base which we are using to forecast the revenues is purely the historical revenue growth of this current company itself, or any other factors which are more and more specific to this company. So whenever I am trying to do the forecast of the revenues or preparing the futuristic financial statements exclusively based on the past details of the company alone, I am calling it as a bottom-up analysis. But on the other side, when I start right from the economic level, link that economy to the industry and link the industry to the company. So based on let's say economic growth, let's say the GDP growth, I focus the industry growth, at what rate the industry as such can grow, and based on the industry growth I look at what rate can the company grow. When I am doing this kind of an analysis, starting at the economy level, then the industry, then the company level, so the revenue forecast of the company will not come from the previous growth rate of the revenues, but it is a function of economic growth projected as well as the industrial growth projected, which will result in the company's revenue growth. So this kind of an approach is what we call as the top-down analysis. And in case a company uses both of them as a part of the forecasting process, then we call those kind of approaches as hybrid kind of model. These are the ones which are more comfortably used in the industry because it helps us to validate one with the help of the other. Now, again, when I am trying to forecast the revenues, now we are going with each and every item of the financial statement. How do I get into the forecasting of each and every item present in the financial statement? So initially when we are starting off with revenues, we are talking about two major methods to forecast the revenues. One is the growth relative to the GDP approach. So I'll try to see at what rate the GDP is expected to grow. So let's say, okay, historically I have seen that when the GDP was growing at 5%, my company was growing at 6%. When the GDP was growing at 7%, my company was growing at 8.5%. Let's say some such kind of historical data was existing. Then probably what I can say is, yes, overall it is looking like my company will grow either 1% more than the GDP or probably 1.2 times the current the GDP growth rate. Some such kind of a relationship we will try to derive either in terms of additive to the GDP. So, okay, GDP has grown by 5%, so my company may grow at 1% more. Or if because the GDP has grown by 5%, I am expecting that my company will grow 1.2 times that 5%, which is like 6%. Some such kind of a relationship which is either in an additive form or a multiplicative form with respect to the GDP growth rate is what I am taking directly to my revenue growth for my current company. And based on that estimate of the GDP growth rate, I am trying to compute the futuristic sales for this particular company. So as simple as this, when I am looking at growth relative to the GDP growth mechanism, I'll first estimate or probably get an estimate of the GDP growth rate, add some percentage to it or increment it by some factor to say that my company will be growing at this particular rate, and use that particular percentage for increasing the revenues to the next period. That is one mechanism that we can use to forecast the revenues. The other, as I am saying, market growth and market share approach. So this is a proper EIC mechanism, economy, industry and company based mechanism. So first look at what is the GDP growth. Based on the GDP growth, don't estimate the company sales directly, you estimate the industry sales. So based on the economy growth, try to identify the relationship between the economy growth and the industry growth. Based on that relationship, identify what is the sales that is expected for this industry. Then again try to identify the relationship between industry and company using the market share. Right? Market share is typically what proportion of the industry sales is contributed by the company. So based on the estimate of the market share, and once you have already estimated the industry sales, you take the market share, estimated market share of the company, multiply it with the industry sales, and then give a revenue number to this particular company for the future. Now, because of this approach, the good thing that might come out is, especially if I am operating with multiple business segments in multiple geographies, in each geography the industry can grow at a different rate in each industry the market share of the company could be different for each industry in different geographies. So overall, when I am trying to predict the overall revenue, it comes out as a much better representation because I get different percentage growths in different geographies. The sum total of them is what is giving me a better picture to forecast my revenues. So that is how we take an entry for the revenues into the income statement. I can use any other approaches also, but most common prevalent approaches are I look at either a direct relationship between the GDP growth and the company growth, or in the middle I bring in the industry growth and link the industry with the company using the market share kind of an approach. Then here one more thing that is worth assessing is this particular company having economies of scale? Very important item for us to evaluate is the economies of scale applicable to this industry. How do I see what is the economies of scale that is getting applied? If I increase my volume as the business is growing, probably look at it like this: as the sales is growing, if there is economies of scale, the cost of goods sold may grow but not at the same rate as sales, but may grow at a slightly lesser rate compared to sales. Which means when I take the cost of goods sold to sales ratio, this ratio should be gradually falling as the business is increasing. As the business is increasing, if I see this ratio gradually falling, or even for that matter any other expenses, not only cost of goods sold, any other expenses, if I am looking at them as a proportion of sales, they should show some kind of a falling behavior, which is what is an indication of the company able to derive better economies of scale, because as the volume increases, the average costs will go down because of the volume. The economies of scale, if they are operating, then the average costs will go down, both of cost of goods sold as well as the total expenses, which will result in higher operating margin. So if at all a company is deriving higher operating margins year over year with the growth of business, means if I am seeing that the sales and operating margins, they are showing a positive correlation, then I can very, very comfortably say that this company is exhibiting economies of scale. So generally, or the other way it is worth looking at is try taking all the firms in that particular industry. If even the largest of the firms have a very high market share, or if our largest of the firms obviously will have a high market share, but check out if they have high operating margins also compared to the other firms. If that is the case, you can very well say that in this particular industry, the top-notch companies are able to exhibit economies of scale. Because when we are trying to get into the modeling process, especially when I have to forecast the cost of goods sold, as a proportion of the revenues, if the company is exhibiting economies of scale, then probably I should not increase the cost of goods sold at the same rate as the increase in revenues. But if the economies of scale is no more applicable, then probably I can increase the cost of goods sold in the same proportion of the revenue. To assess that particular part of the income statement, we typically evaluate whether the economies of scale is present or not. Then once we have decided no, there is no economies of scale, then we are also looking at each and every expense part, okay, COGS. in general, people take the common size income statement, at least for the last 3 years, and find out the COGS as a percentage of sales and almost every element of the income statement as a percentage of sales. So that particular ratio, historically I take one number as the COGS as a percentage of sales. Though there are for last 3 years there are 3 different values. Either I may take the average of all these 3 or I may take the recent one as one single value for the projected COGS ratio. And what I do is that particular percentage I multiply with the future revenues and use it as the cost of goods sold for that particular period. The only thing we may have to consider is if there is some kind of a trend in this ratio, right? COGS as a percentage of sales, okay, every year there is a drop by 1%. Right, initially it was 75%, then the next year I saw that COGS is 74, then it is 73. Do I need to make the next year as 72 or should I keep it as 73 itself or should I keep it as 74, which is the average of all these 3? All these 3 scenarios are possible. If this trend is going to continue, probably the ratio is coming down because of economies of scale. If I expect that for one or two more periods this trend may continue, then there is no harm for me to assume 72% for the next year. But if I say no, this may not be possible, the firm may have to continue at this level itself, then we are talking about 73. Okay, this is only one of kind of scenario, otherwise I'll see that the average behavior persists for the next few years, then it may even force me to use 74. So based on how we are able to assess the various costs, input costs that are going into this business, we may have to take an appropriate number accordingly. So initially on a very crude note, people look at the percentage of revenue as the input for the future, but small differences may very well come up, especially if the trend is expected to continue, or probably it is also better to understand the inflation forecast. Okay, probably the next couple of years the country is going to face heavy inflation. Some kind of forecast talked about the inflation of the country in the next couple of years. And then understand, okay, will this particular input also face a very heavy increase in the price? If that is the case, probably it's better for me to increase the cost of goods sold as a proportion of sales, not just at 73 or 74, but probably a 75 or 76 would be more appropriate. And along with the understanding of inflation, see if it is possible for the company to get into some kind of derivative contracts to hedge the exposure to that inflation risk. If it has already got into any of the contracts to fix the input prices for the next few years, either using derivatives or in terms of contract or agreement with the counterparty, wherein the prices of the input for the next few periods is completely fixed. In those cases, I need not look at very high values for the cost of goods sold as a proportion of sale. But if no such kind of hedging or anything being done, and I am expecting a couple of years of high inflation, then even those numbers need to be taken care of as a part of our futuristic COGS. And it is also advised that just like the revenues, you create separate COGS for separate products, for separate geographies, separate business segments, because every cost is unique, and in some cases the cost is much higher in some businesses, in some products the cost is much higher compared to some other, at least it gives us a scope to evaluate things much more effectively. So that's what we take as a part of forecasting the COGS. Then when I am looking at other operative kind of expenses, generally I break them into two parts. One is the fixed expenses, at least in the short term. Fixed in the short term kind of expenses, the salaries to people, especially at a management layer and all, the R&D costs, they are assumed to be stable for the next couple of periods at least, and they may not be linked with the revenue too much. So they may be like a constant number for 1 year or at least 1 to 2 years. Whereas when it comes to the other expenses like selling and distribution, marketing and selling kind of costs, what we see is they are directly linked up with the revenue. If I have to sell more, I have to spend more on marketing people, I have to spend more on advertising. So these kind of costs are directly linked up with the sales. So they, when projecting them, historically I will consider their proportion with respect to the revenues and use that percentage as the number based on the futuristic revenue forecast for the for forecasting the future income statement for the next few periods. So even for these things also, identifying segment wise expenses would definitely bring more and more betterment to the estimate. Then coming on to the finance costs. In the finance costs, we talk about gross interest as well as net interest. Net interest, of course, is the more interesting, important aspect. So gross interest typically comes from whatever is the debt that is outstanding and the interest rate. These two can very well come from the footnotes to the financial statements. So here if I can understand, okay, till how many more years is the debt, will the debt be outstanding and what are the interest rates that are applicable. Based on these two things, probably I can very well go for a gross interest expense. And that gross interest expense is completely the expense that is involved based on the loan that has been taken. But there could be some kind of interest income also, especially when there is a cash or some short-term investments. These can generate some kind of income. So if I subtract the interest income from the gross interest expense, that is what we call as the net interest expense. So even as a definition also, when we talk about gross debt, it is the total debt that is outstanding. But if I subtract the cash and cash equivalents from it, then that is what I am calling as net debt, because I could have used that cash to pay back some part of the debt. So that is why I call it as net debt. But yes, when I am trying to look at net interest expense, it is gross interest expense minus whatever is the interest income that is coming on the cash as well as the cash equivalents that I am holding. So as a better forecasting mechanism, you understand when is the debt, how long is this particular debt applicable, till how many years the interest need to be paid, what is the time when the principal repayment has to happen. All these things understood very clearly from the footnotes to the financial statements brings more and more clarity when you are trying to do the projection of the financial statements. And finally, one more aspect that needs to be looked at in the financial statement, in the forecasted financial statement, is the income tax expense. What kind of tax rate I need to take? Generally, we talk about three types of tax rates. A statutory rate, which is primarily the tax in that particular country. The effective tax rate is actually what is the tax expense as a proportion of the PBT, and cash tax rate is what is the tax that is actually being paid. There is a difference between these two aspects because of the concepts associated with the deferred taxes. What is the tax which I am actually paying versus what is my tax expense? So, because of the deferred tax expenses and the changes in the deferred tax expenses, I may end up paying either more tax or less tax, which is what gets captured as a part of the cash tax rate. But when we are trying to forecast the financial statements, what we are trying to represent is take the expected effective tax rate, whatever could be the effective tax rate for the next few periods, multiply it with the PBT for that particular period and arrive at the tax expense. But before we put the number, it's always advised that check out if there are huge significant differences between what would be the tax if effective tax rate is used versus a statutory tax rate, because the difference between the two, the reconciliation between the effective tax rate and statutory tax rate typically is found in the footnotes. So you can very well check out if there is any kind of huge discrepancies or huge differences that are coming between the taxes because of the usage of these different processes, especially for a firm which is operating in multiple geographies where the tax rates are different in each of the geographies. You find a big difference between the effective tax rate as well as the statutory tax rate, and any kind of permanent differences that are present means you are showing it as an expense, but when it comes to the tax deductibility is present on that. In all these kind of cases, you see effective tax rate will be different from the statutory tax rate. Try to understand all these, and heavy discrepancies need to be researched a little bit more so that a better forecasting of the tax can be done as a part of the preparation of the forecasted financial model. Then the next aspect that is coming into picture is the balance sheet part. To a large extent, the elements of the balance sheet also come from the projected income statement itself. Especially if we see the element of retained earnings. Retained earnings is nothing but the net income minus the dividends that have been declared or expected to be declared in a particular year. So whatever is the dividend expense, I subtract from net income, and the remaining is what is getting carried forward to the retained earnings. And probably the other elements like share capitals and all may not change unless there is an explicit issue of additional shares during a particular period. And when it comes to the various working capital elements, especially the various elements of current assets as well as current liabilities, it is better again to link them with respect to the forecasted revenue itself, which means if we understand this process correctly, if I am able to do a forecasting of the revenues better, all the other things are typically linked up with the forecasted revenues itself. Similarly, the working capital related items, whether it is current assets like accounts receivables or inventory or accounts payables, at least for all these things we have a linkage with respect to the income statement elements. So more or less like turnover ratios, account receivable turnover ratio, wherein you have an income statement element in the numerator and the average account receivable in the denominator. The same way with inventory, same way with accounts payable. So most of the working capital related items, I can generally look at them in proportion with the revenues or in detail corresponding to their turnover ratio. So probably I can observe historically the turnover ratios. Right, historically I can take the turnover ratio of the company, and based on that maintain the similar layers of turnover ratio for the future also, And now that I have the income statement projections with me, either it is the revenues or the cost of goods sold. Now that I have the income statement projections, I can use those values to project the working capital elements on the balance sheet. Then, when we are coming to the property, plant and equipment, even for that also people look at the turnover ratios itself. But in some cases, it's better to go with the depreciation and the capital expenditure kind of an approach. So, how much of it, what is the kind of depreciation that is happening in each of the periods, and how much of new expenditure is coming up in each of the periods. Now, on one simple way is, if the business is a very matured kind of business, probably I can always look at capital expenditure in proportion with the sales itself. But in some cases, what could very well happen is the company might have invested very heavily in some big assets this year, which are expected to give some kind of benefits over the next few years, not just immediate 1 or 2 years. So in some cases there could be a very heavy capital expenditure. In those cases it becomes slightly difficult to use the percentage of revenues kind of an approach. So that's where it's better to look at the depreciation and the capital expenditure, and that too if I am able to break the capital expenditure into what is required for the maintenance part, which means it has to be replaced because it has become old, and the other thing is for growth. Yeah, now I have expanded my business, so I need a few more capital expenditure to be done. So these things, if I am able to segregate them separately, then a better prediction of the property, plant and equipment will come out for the future. And depending on once we have prepared the entire financial statements, it's better that we perform the sensitivity analysis by changing each and every element of the financial statement, see how much will it impact the net income, how much is it going to impact over the next few years. All such kind of sensitivity analysis can very well be performed once the financial statements are prepared, to check the validity of the financial model thus prepared. Now, once the financial statements are prepared, one thing that we are very interested in is finding out the return on invested capital. So the capital that I have invested will include both equity as well as debt. So when I say ROIC, what is the return post tax? So whatever the profit the company has generated, operating profit, whatever the company has generated, adjusting for taxes. Because the operating profit, let's say if I am assuming EBIT is the operating profit, I generally adjust it for taxes and say this is the operating profit divided by the invested capital. The invested capital, I am looking at both the equity as well as the debt capital. In other way, we define invested capital as operating assets minus operating liabilities. So that is what is going as the invested capital, and it is a return both to the debt and equity. In some cases, people prefer it much more than the ROE. ROE is a return on equity only for the equity in equity capital. So generally looked at as net income divided by the equity capital. Whereas here we are looking at the capital wise, both equity as well as debt, and the return wise also the return which is applicable both to equity as well as debt investors, not the government for the tax. Right? So this is a much better thing than ROE, and especially if I have to compare two firms with two different capital structures, ROE is not a good mechanism at all. ROIC will become a very good mechanism, because we are ignoring the capital structure. When I am comparing two firms with two different capital structures, one is an all equity firm, the other is a 50% equity, 50% debt kind of a firm, it makes all sense for me to compare them before the debt and before the interest payment kind of a phase, wherein I am looking at the total return which the business has generated as a proportion of the total capital that has been invested either in equity or debt form. So the higher the ROIC, probably it is an indication for me that the company can derive some level of competitive advantage either with respect to increased sales or with respect to decreased costs. So ROIC is a much more better mechanism compared to ROE, especially if different firms in the industry have different capital structures. A slightly better way than ROCE or ROIC is ROCE, return on capital employed. So which is again invested capital itself, but the only thing is this does not take post-tax. It takes pre-tax operating profit. Means this is even more good for companies, not only with the different capital structures, but with different tax structures also. Even a comparison can be done with companies which have not only different capital structures, but also different tax structures. So it's better that I understand the concept of ROIC or ROCE, how we can use that for a comparison of the firms with different capital structures and different tax rates. Because as an analyst, I need to understand, once I make a forecasted financial statements, I need to understand on what aspects is company 1 better than the company 2 or vice versa. Then the other dimension that is worth looking at in this context is, based on the industry analysis, how can I plan out the forecasted financial statements? Can I put a higher numbers for revenues, or can I put falling numbers for cost of goods sold? So how do I use the competitiveness of a company in the industry, or probably assessing the 5 factors of the Porter's model? How do I take that into consideration to prepare the forecasted financial statement? So some of the inputs that I can look at, yes, in this particular industry, if the threat of the substitutes is much higher, I can very well say, no, this company will not have much of a pricing power, which means I cannot increase the revenues quite drastically, because this particular firm has a threat of many substitutes. So there is no way at this point this company will have any kind of a pricing power, and that too especially if the switching costs are much lower. I cannot expect any big pricing power for this company in the short run. Similarly, if the competitors are too high, then also there may not be any possibility of a pricing power. If the bargaining power of the suppliers is very high, there is a good chance that my input costs are going to go up in future, which means my profit potential may go down. Probably my earnings, my revenues may or may not go up in proportion with the expenses, but I am sure expenses are planned to go up because the bargaining power is very high with my suppliers. But when I look at the bargaining power being higher for my customers, I cannot even increase the price, which will result in the revenues not growing that heavily in proportion with the expenses. And if the switching costs are much higher, there is even no more chance of me increasing the price. So the revenues may not grow beyond a certain extent. And if the switching costs are much lower, or if there are few customers who are contributing a significant portion to my entire revenue, even if few of them switch, it will have a very big impact on my revenues, especially if the threat of new entrants and also if the threat of new entrants is much higher. In future I may not guarantee, or I may not have any kind of confidence on the growth in revenues as well as the profitability. So here 2 things we are assessing. Is it possible to have a pricing power, because when there is a possibility of a pricing power, I may think of increasing the revenue growth by a certain extent. The other dimension I should see is, okay, keeping the revenue power aside, is there any possibility of cutting down on the costs and increasing the net income or the earnings for those in the futuristic period? Even if that is not feasible, then probably I can that has to be assessed separately for each industry based on the Porter's 5 forces model, and based on that scenario I can talk about the competitiveness position of the company in that particular industry. So that's how I can link the industry analysis with my projected forecast percentages in the preparation of the pro rata, in the preparation of pro forma financial models for the future. Especially if inflation is present, we have already discussed, if inflation is present, the input costs can typically go up. Right? If inflation is present, input costs will go up, which means the COGS will go up. That's a normal scenario. But a few more things here. If the COGS is going up, one thing is I may even increase my sales price also. But if I have to increase my sales price, I have to see, will there be any fall in my quantity sold? Because if price is increased, there is a possibility that the quantity sold will decrease. For that I need to evaluate, is there what is the level of elasticity? What is the level of elasticity of demand for my particular product? If the elasticity is where we are defining elasticity as percentage change in quantity by percentage change in price. If the elasticity is very high, greater than 1, right? If the elasticity is greater than 1, we are calling it as more and more elastic. And when it is more and more elastic, we may see that the quantity of sold will fall drastically, which can even result in the total revenue falling down. That's a more common behavior, especially if the products are more or less substitutable. So what we have to typically see is, if the input cost is going up because of inflation, there is a possibility of COGS going up, but sales may not go up by that extent, which means the net income or the earnings of the company may have to go down during that period of high inflation. And the other side, okay, to make sure that the COGS is not going up, if the input prices are going up, I have to see whether the company has got into some kind of derivatives based hedging process, or did it get into some kind of fixed price contracts with the vendors. Any of these things, if the company has got into, then as a part of our forecasted model, even though the input prices are going up, we will not increase the COGS at all. Otherwise, I may have to increase the COGS, and we have to constantly keep evaluating where all the input costs, what all could be causing the input costs to go up, because they are geography specific. For each product category, the input costs can go up in a different manner based on inflation. Sometimes weather can impact the input costs very much, especially agri commodity kind of inputs. If they are there, they may be very heavily impacted by the weather. In some cases, the input costs change drastically by government regulations and all. So as an analyst, there should be a heavy focus in terms of what all scenarios can drive the input costs on the higher side. And if these input costs are going up, is there any possibility that the company can maintain its COGS, or even the COGS has to be raised accordingly itself? And in some cases, understanding the pricing strategy of the company also is very much important, because The company may very well feel, okay, let the costs go up now. This cost going up is more and more temporary. So let's absorb the costs by trying to cut down the costs elsewhere, but let's not increase the price for our customers. But that may work well in the short run. But what to do in the long run? If this strategy, if this increase in the input prices is no more temporary, then the company is forced to increase the price, which may result in loss of customers also. All these problems may not be that heavy for vertically integrated companies, especially the raw material. Again, the input again belongs to the same company only. If I say the input costs have gone up, but my supplier for the input is my own subsidiary only, in that case, probably the impact of inflation may not be much higher, especially in case of vertically integrated kind of companies. The impact of inflation may not be that higher. Whereas in all other cases, any inflation, unless it is hedged properly, yes, hedging again may have a good side as well as bad side. Though it is, in case of inflation, it is good enough in terms of fixing up your input price. If the prices have actually fallen, still you end up paying the same price, the hedged price itself. So in that case, actually there is a loss also that is occurring. So what we are typically seeing is, whenever we are getting into a hedging process, it may work in the either way. It's only the risk. It's only the risk that is getting controlled. It's whatever the number that we are putting in the COGS, it may not change quite drastically. So what is being estimated will be more or less similar to what is going to be actual. So only from that dimension we are looking at the hedging process. So the volatility or the fluctuation will be much limited while getting into the hedging process. But as a concept, it needs to be understood that in case of countries where the inflation levels are much higher, I have to make appropriate reservations for them as a part of my forecasted financial statements, unless some kind of hedging or contract fixing kind of activities happen from the perspective of the company. So the other dimension to look at, typically, what is the kind of role that technological developments play on the forecasted financial statement? One way to look at is, most of the technological developments, at least in some cases, we see that the production costs may go down. The higher the technological advancement, probably the cost of operations, cost of production may typically go down, which means the cost of goods sold will go down, which could result in increased operating profit margins. At least for companies which are the early adopters of the technology, where the cost of technology is not that high, but definitely that will result in the production costs going down, which could result in overall profits going up. That's one side. In some cases, the technological development can improve the substitutes, which could act as a big cannibalization factor for the existing company itself. When I have introduced a new product using a new technology, obviously it may kill my existing product which was developed using the older technology. So whatever the kind of additional sales that I am able to generate because of the new technology, I also need to consider that there is some kind of a lost sale because of the existing product which I was having. So even the cannibalization factor, which is purely what proportion of the sales of the new company or new product is contributed by the old product which was substituted. And the technological development sometimes can rupture the whole industry itself. So while trying to do a modeling based on the technological developments, all these factors need to be very thoroughly understood, and then incorporated into the financial statements. Then, what is the time period? What is the duration for which the forecasting has to be done? 3 years, 5 years, 2 years? What is the time period? Or infinite? There are some key things regarding this, especially when the target is from buying a share or buying some shares in a particular stock. So from a buy side perspective, if the analysis has to be done, then whatever the forecasting period is basically the expected holding period. If I am thinking of expecting the stock for the next 5 years, it's better to do the forecasting for the next 5 years and so on. So it has to be more or less in line with the investment strategy only. But if I am looking at a highly cyclical kind of companies, which especially as a sector like a real estate sector, which actually booms very well when the economy is doing good and may not perform well when the economy is not doing well, and which has a kind of a cyclical nature. In some cases, the growth rate is going to be superficially higher. In some cases, the growth rates may be pathetically down. In those kind of highly cyclical kind of companies, it is advised that you make a forecast until the middle of the cycle. So if I am assuming that the gap between the peak and the trough is going to be 15 years, and somewhere in 8 years or something the middle is going to be there, you actually make sure that the middle is there as a part of your forecasting process, so that the normalized earnings can be taken. Okay, because this is a boom, what if it has been a normal year? Do a normalization. All these boom periods as well as bust periods, you normalize the earnings, adjusting them for the business cycle changes, and probably bring them to this level. What if it's not a boom period? What if it's not a trough period? What could be the revenues? You do a normalization to the revenues and then use them as a part of the financial model. And in case there are any big corporate restructuring events like mergers, acquisitions, all these kind of scenarios, any kind of stock grants or any such kind of corporate restructuring events that are there, think that their impact is pretty much temporary. So include the forecasting period, generally a slightly longer period, so that whatever are the benefits of this diversification or merger and acquisitions, they are evened out during this entire period. So choose such kind of slightly longer period so that this impact, which is more or less temporary, is completely realized during that entire forecasting period. So the forecasting horizon should be chosen from that kind of perspective. And what about beyond the forecasting horizon? Let's say beyond that period, if I want to forecast, there we use what we call as a terminal value. Terminal value is from that period onwards till infinite, assuming it as a going concern. From that period onwards till infinite, if the company is going to operate, what is going to be the value at that particular point in time? Today is this. We have done yearly forecasts up to this particular point, and beyond this forecasting horizon, I am calling it as a terminal value. And to arrive at this terminal value, what we generally do is we try to assume the revenue growth for this period more or less similar to the previous period before the terminal value period is starting. So here, if I have to forecast the price here, either I use the DCF mechanism, assuming the cash flow will grow at some certain percentage year over year for infinite. So a constant growth kind of a model is what I am proposing from this period onwards, if I am using a discounted cash flow approach. or I can say some kind of price to earnings multiple. So here I will be knowing what is the EPS for this particular year, and I'll assume some kind of price to earnings multiple, based on which I will decide what should be the price at this particular point in time. So if I am using the relative valuation approach, choosing this proper multiple is a very important thing. And if I am going with a discounted cash flow approach, identifying what is the growth rate of the cash flows for infinite, and at the same time what is the definition of the cash flows. In some cases we use dividend as the cash flow, in some cases we use free cash flow as the cash flow, in some cases we use residual income as the cash flow. What is that definition of cash flows which we are trying to use? That is one more thing that becomes more and more crucial. So the end objective is, especially for forecasting beyond the horizon period, either I compute the terminal value using a P by E multiple, or I use a terminal value approach using a discounted cash flow process, where I compute the cash flows growing at this particular rate, which will help me determine what is the present value of all those future earnings until perpetuity. And apart from that particular process, it is expected that the analyst should be comfortable in terms of understanding the inflection points wherein the history may not be the same as the future, especially if the economic environment has changed drastically compared to the last 10 years. There is no point in using the historical data for the future. Same way, business cycle change, technological advancements, these are all typically treated as inflection points, which are basically that the historical numbers may not be any kind of reflection for the future numbers. So just as a quick summary of what we do as a part of forecasting your financial statements, as a first step, I estimate the revenue growth, either using the growth, either by using the growth relative to the GDP growth approach, or market growth to market share kind of an approach. Whatever is the approach, first I predict the revenue growth and then get into the forecasting of the expected revenue for the forecasting horizon. For all those periods, I estimate COGS, I estimate other expenses which are there as a part of the income statement, wherein I even estimate the financing costs, the taxes, all those things, and even the changes in the deferred taxes, which is what is the difference between the income tax expense and the cash based taxes. Same way, then get into the balance sheet, identify whatever elements that flow into the balance sheet from the income statement, fill up those things, then use appropriate methods to fill up the property, plant and equipment, capital expenditures, and fill the remaining items of the balance sheet, and then do the balancing of the balance sheet and perform the appropriate sensitivity analysis, scenario analysis to make sure that various possible fluctuations in the elements of the balance sheet are thoroughly tested. So this is how we get into the preparation of a pro forma financial model, and once that financial model is in place, we can use our various valuation techniques to typically find out what should be the value of the equity share. Alright. So I hope you got a decent level of understanding on what goes into the preparation of a pro forma financial model. In case you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.